Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts and Vinit Bolinjkar of Ventura Securities, Kalra of Target Investing and Umesh Mehta of Samco Securities join me on the show. Thank you to all of my guests for joining me. Today on Hot Money, we'll discuss IRB Infra, we'll discuss Kaveri Seeds, what exactly has gone wrong. Kaveri Seeds another 6% down in trade. UPL has been resilient in the market ever since the crack that came in on the Arista acquisition. Post that, it's moved up just one way. And since the market is looking extremely weak, we're asking our guests which are the top stocks or themes that should be avoided clearly in this market. But let's start with stock, and the first stock that we want to discuss is IRB Infra. Now, IRB Infra was down 9% in trade yesterday. It's down another 1%. It's the leading toll player in the country, but nevertheless, there's something that seems to be plaguing IRB Infra. It's corrected over half in the last 12 months. So, Vinit, what's gone wrong with IRB Infra? Anything that you've been able to dig out? What's gone wrong?
So one is there's very slow growth in toll collections. Two is a couple of their projects are held up due to land acquisition, because of which HAM project EPC construction will go down. And you know, when you are, we don't do active coverage on that, but you know, a lot of brokers are saying that EPS will degrow. So FY21 stock is available at 12 times. It seems benign valuations, but when you don't have a growth story in a country which is a high growth story, why would you want to invest in that stock? So we would prefer to stay away from it. And what bothers me is that on a Mumbai-Pune expressway, which is got real good traffic, if you're saying that the traffic collections are not coming through as expected, then there is a problem. Okay. And cash flows are negative. You know, large portion of your business is coming from toll revenue. So cash flow should not be that negative. So these are a few of my concerns, and I would not be.
So basically, if you see, I think people are saying infrastructure is slowing down, but one segment in the infrastructure which actually has traction is roads and highways, because Gadkari is actually pushing for it. The other sectors, you believe, with the capital goods out where there's no traction, but roads is where traction is happening. Is there any stock in the roads thing that you should play, or you should totally, even though growth is coming in, you should avoid this space?
So you know, most of the road companies are promoted by political entities.
Sure.
You like it or not, that's the truth. So I believe that you should wait for it's a prudent strategy to wait for the new incumbent government to come in and then go with infrastructure space. Till then, it's definitely an avoid for me.
Totally infrastructure space is an avoid for you.
Absolutely, because you know, if you're not the favored few, you will not get the projects. And when you don't have loan growth, you don't have order book growth, you know, you just simply wither away.
Okay. Samir, you agree that this space should be stayed away from, or are you telling your clients to start investing in infra?
So we think FY20 will be the slower growth, where all these road companies especially, because they were high growth in FY18 and 19. Now the order inflows will actually reduce out, because for first half you actually go through elections, the new government settling out. So that really takes out the order inflow visibility. On the second side, the execution is happening. The execution is not the problem in many projects, but the receivables are blowing at the same time. So the payments are getting slower day by day, because the elections get closed, the fiscal issue still persists. So government holds on to the dispersals, which was not happening in FY18. So I think the valuations still look very good as compared to the future FY20 growth, and we still believe there's a further downside in the sector as a whole.
Anything on IRB that you spotted? What's gone wrong with IRB as such?
So IRB, whatever, if you see the balance sheet, even the receivables have gone up by 30% in March ending towards September ending. And as he said, there are certain projects which are held up for land acquisition. So when this happens, your working capital is actually going on. It's not that your working capital requirement stops. So I think they'll face, at a certain point, they might face or they might be facing funding issues. Because their assets are still into limited and they're already leveraged by 1.5. So I think they have a very limited space to increase the debt to fund the whole other operations. So I think they'll face a funding issue.
Anything in the road space that you like should be avoided as an investment opportunity, or is it a total avoid?
Not as of now. FY20 we really want to avoid the whole sector.
Okay, Umesh, have you told any of your clients to start accumulating in the road space, road developers, or do you share the similar views that Samir and Vinit are having?
So yes, I think road sector is quite interesting. But let us talk about IRB.
Yeah.
So IRB, why at this fag end there is sudden fall in the stock is because the debt is around 1.3, right? So 3 times debt to equity is what the ratio is. So we are in a bear market which is 14 months old, right?
Yeah.
So in the fag end of the bear market, always the stocks that are beaten down are with high debt or corporate governance issue. So all those things are ones which have got the knife. So this is one of the reason why there is a sudden collapse or fall in the IRB stock. Second is, although it is an annuity model, right? They are collecting tolls, but the fear that the tolls may get freezed or something, their business model per se might get impacted. Rather than pure EPC contractor or HAM contractor, for them there is visibility because so long as the contracts are there, they will have their cash flow. But considering that toll is a substantial part of their revenue model, if that gets impacted or government say that okay, go home, I'm going to manage all everything will be toll free in Gujarat, Ahmedabad. We don't pay toll on the outer ring road. If something like that happens, so that was the fear which kept the stock under check since last 2 years.
Okay.
So that is one of the reason, and because of that, in this fag end we have seen the fall. But apart from that, I think still IRB is a 4.5-5% dividend stock, lowest compared to P across the industry. So the P ratio multiple is the lowest, high dividend yield, and if I'm not wrong, I've checked the debtors turnover ratio is one of the best in the industry which they have. So there is nothing per se that one should avoid. Given that this lower valuation, given that there is a lot of pessimism, I don't think if I have the stock, I will not sell at least. So now the next question is, will I buy? The answer is, I think that's selective, depending on the risk appetite and depending on what suits and how is the portfolio one wants to allocate. But there is nothing wrong per se in the road sector because valuations are reasonable and there is enough margin of safety. So allocation can be made.
So you're saying start nibbling into IRB? Is that something that you're saying?
So in fact, a basket.
Okay.
So it can be a basket would be a rather better strategy. We can have KNR Construction, which is one of the most efficient, consistent player. We can have IRB. So all those stocks can be accumulated.
Okay. So that's the view that's coming in. Two of our guests believe that IRB or the road sector is a clear avoid, but Umesh has the belief that this is a start. It's a basket approach. Start nibbling into the road sector because the downside probably with the valuations could be limited. The next stock we want to discuss is Kaveri Seeds. Now again, after the sell-off that we saw yesterday, again today there's a big sell-off. It's down 6% the last time I checked. It's down now 7% in trade. Again, on the conference call also, there was no more major clarity, especially in terms of some of the contract licenses as far as some of the states were concerned. Is this a corporate governance issue? What exactly seems to have gone wrong with Kaveri Seeds? Is the balance sheet strong? Because a lot of notes have come out that, questioning the balance sheet strength of Kaveri Seeds. It hasn't fallen much on a 12-month basis. It's down just 5%, but the last 6 months is down 30%. Not as bad as the other companies, but Samir, Kaveri Seeds, how does that look to you? Have you studied the company and what does the balance sheet or overall trend indicate?
So at a certain point we used to study this company, and at that point we believed that there are certain corporate governance issues in terms of related party transactions. The licensing had a big issue going on in the legal sense as well, and it was very state dependent system of majority of the business, and which recently when you see Andhra coming up for the licensing stoppage over there, that suspension has really hit their revenues. And they are mentioning in the call also that FY20 onwards they'll have a growth, but if that suspension still extends or passes on to other states, that is a major risk as of now. And even if you see after this fall, the valuations are not that attractive. So, and the last results were really surprising for everyone, and the hit was very major. So even if it extends to a couple of quarters, I think the valuations have much more downside as of now.
Okay, that's the view that's coming in on Kaveri. What about you, Umesh? Kaveri Seeds, what do you make of the company?
So it's avoid. But let us also understand the broader picture. India currently is one of the is having the highest arable land across the world. So 141 million hectares. So no other country has such huge land mass for agriculture. It is what it produces 275 million tons of food grain, second highest in fruits and vegetable, 272 million tons. So that is a potential. So now, are companies like Kaveri Seed able to capture the potential? So structurally, India is into a difficult space. Fragmented holdings, farmers have ancestral property, they are not interested. So this is how the entire structure is, and therefore not only Kaveri but many agriculture companies are not able to penetrate and capture the growth. Pie is there, but somehow or the other there is no demand. So that's a difficult state of situation. Now Kaveri once upon a time had a beautiful run because of consistency and growth. Market had given 40-45 times earnings multiple, but soon, because promoter had sent out an intention that I will sell my part of my holding and I will myself do exotic agriculture in some typical crop. That was a time when market realized that there is something wrong, promoters focus or whatever XYZ reason. After that, there has been a continuous fall in Kaveri Seed. In spite of buyback, still the stock price is under pressure. But the model of Kaveri Seed is very limited. There is a huge bucket that they can capture. For example, UPL. UPL has tremendous entire value chain they cater into, and that is the reason why UPL is far superior in terms of consistency, in terms of numbers. But Kaveri Seed has its focus limited to cotton seed, soybean seed, in focused area of Maharashtra, MP, Rajasthan. So there is a limitation. So I don't know, something, so if an investor gets a chance to enter into agriculture sector, I think Kaveri Seed is not the right place because it's into very niche and there are risks attached because there are copyrights. Monsanto might come and say that, oh, you have played my, and plus Andhra Pradesh government has said that you have without our permission done this, and there is a threat of license cancellation. So all those will not, so as an investor I will not like all those things and put my money at this juncture. At the same time, there is a stock like UPL, which we'll discuss later, is far more safer if we want to play the agriculture thing.
Okay, well Vinit, what did you make of Kaveri? Did you have a chance to look at the numbers and the con call details?
Yeah, so I think, if you see the revenues are very bunched up in Q1 and that suspension on the cotton seed issue is going to hit them the most because cotton seed is the one which is sold the most. Secondly, we have a surplus in terms of cotton seed and cotton acreage is coming down because the pricing is not favorable. So I think Q1 will be the hit and the losses will be amplified when the Q1 results will come, unless and until the company is rapidly able to grow its other portfolios to take over cotton. So in that case, I think it's avoid. Having said that, it is one of the best seed companies in the country. And I would not be buying at it, as he pointed out, Kalra pointed out that the valuations are expensive yet. So if I'm anticipating a loss, why would I buy into it?
Is there any balance sheet concern? Because that seems to be the the main point that comes in a lot of discussion that there's something wrong with the balance sheet. Have you spotted anything like that?
No, I have not spotted anything to that extent. But purely the business fundamentals don't forthwith want me to go deeper into the company and have a look at other things because the background is only not that encouraging to want to invest in the company.
Okay, did you spot anything in the balance sheet, Samir?
So earlier there were a lot of related party transactions which was using a lot of the cash. Nothing beyond that.
Nothing beyond that. Have you spotted anything in the balance sheet or something? Okay, that seems to be the way that's speaking of Kaveri, but it's a clear avoid at this point of time. Again, UPL is another counter which has done well. Now, if you're playing, the counter did correct significantly ahead of the Arista acquisition, but post the acquisition that happened, the management clarifying what kind of synergies that will be, the counter has managed to rebound. So it's one of the very few nifty counters which has managed to give you a positive return. So in the last 6 months post the big correction, it's up almost 33%. So there is strong traction in UPL. How will this acquisition play out for them? How were the numbers? What's the way ahead? That's something that we'll ask. I'll start with you, Umesh. You were quite happy to discuss UPL. What do you make of it? Should an investor get into UPL, or should they wait for a correction, or should they avoid?
So UPL currently is available at 20-25% premium to all the listed stocks which have India focus. So the best part of UPL was they knew that there is a limitation in India in order to crack the market. So they diversified and went across the world, emerging countries like Brazil, Argentina, and their wings have spread across the world. And they focused on agrochemicals, on seed, nutrition, entire value chain. So currently UPL has the entire value chain in terms of what the farmer wants, right? In terms of and providing logistical support, providing training. So in a way, UPL was smart enough to understand that there is a limitation, and therefore they did across. So coming to the acquisition, I think that acquisition, they have that learning curve, and in the past also they have done acquisitions. Hopefully we pray that things should go all right and they should be able to get the synergies and leverage and go higher. But if something really goes wrong, but that acquisition was huge, hopefully fingers crossed, things should be all right. But given the valuation, I said it's still attractive, given the industry leader and the growth and the efficiency with which UPL is operating. I think it's worth considering taking risk in this stock.
Okay, what about you, Samir? Would you buy UPL at this
So
level?
for us, it's a hold as of now because of that acquisition which they have taken on. So they have taken a large burden on them in that certain sense. The synergies will take time to come out. Even if you see the acquisition, if you see the local books, the inventories have swollen up around 40% in September end. That has to clear out, and we don't see a very good Rabi crop season coming in. The sowing has reduced. So I think that inventory will face a burden over there. The debt has increased on the local books as well. It's come to around 9,000 crores now from 6,500 crores. So we see a lot of stress on the balance sheet as well. So that's why we have kept it on hold, though it provides the whole array of products to the farmers. But the sowing going down will not impact that upside, and it will create more downside issues for them.
Okay, is UPL, if someone wants to pay the agri theme, should UPL be the stock, or are they any better?
So for us, we stick to MNCs, so we've stick to biocrop in the whole theme, because over there the cash flows are much better than other companies. So we believe in cash flows as of now.
Okay, Vinit, what did you make of UPL numbers? How they managed to pull up?
So they've done well in all the global markets. They have beaten expectations. Okay, but there's a slight extraordinary expense, which is 91 crores related to merger and other issues and restructuring issues in South America. So I think all these numbers which are below the line. Okay, so you make your profit and loss and your balance sheet look very nice, but when you have these write-offs that come in, these are very unnerving for me. So that is number one. Second is valuations, as Kalra pointed out, are expensive. Third is the fact that the Arista, they are back-ended 21 onwards. $220 million of synergistic expectations, which will add about 8 to 9 rupees more to their earnings. But it's too far out. And you know what? We are in for a slow global growth. If you see consumption in the US is falling down, electronic exports from Singapore were down 15%. So this kind of data tells you that global growth is slowing down, and you are a global company. So you are also going to be impacted everywhere. So I'm not very comfortable with the stock right now. At best, it's a hold.
It's a hold. So that's the view that's coming in on UPL. And the final stock, since the markets are extremely volatile and some of the stocks actually optically look very, very cheap, but is this the right time to get into certain stocks which have fallen significantly or no? So we are asking our guests to talk about some stocks that should be, even though they've fallen significantly, it's a clear avoid, or they can be counters which are actually trading at record valuations. That's something. So Vinit, which are the stocks according to you, which despite follow anything should be a clear avoid right now?
I think Tata Motors.
Okay.
So my rationale is threefold. is that you inherited one of the most iconic brands, one of the best managements in the country, and you had the best of markets. China. Your China sales are down 70%. You said you will better from next month onwards. January numbers are down. And you know, globally, you are imploding sales. Your cash flows are a mess. You have debt, which I do not know how they're going to repay. Okay, they have floundered with monetizing their asset. They picked up the JLR company at very aggressive valuations. So I think optically, although the replacement cost theory, people will say that it is very, very cheap and the promoters also buying the stock. I think there are serious issues around cash flow generation and lack of imagineering in terms of piloting a turnaround. I don't see anything happening to that stock, so it's my top avoid.
Okay, what about the fact that, you know, initially it was JLR which was driving sales. Now that's gone down. You don't think there's any way when the market in China improves or anywhere that the turnaround can happen at?
See, you know, when an economy slows down, you don't lose 70% sales. 70% sales mean there is something seriously wrong with your business model. You know, sales don't crack so much. And you know, you're a very fledgling company compared to the global biggies that are there. You have a very, very iconic brand. And you know, you're catering to the super rich in China because you're a high-end model. So those kind of sales are not really impacted. So, and your valuations were, because of, you know, expected high growth, were always at a premium to that, to the other players. You know, you got Indian valuations. So, you know, globally Merck, Audi and all these guys get about 6 times book, 6 times earnings. You were at 12, 13 times. And you know, on the domestic front also, you have lost out to smaller players. And you have to resort to very, very aggressive pricing just to maintain market share. And I don't think it makes business sense to lose money and maintain market share. Okay, on the PV front, your lack of imagination, your vehicles are not doing that well. So, you know, all 3 portfolios are doing so badly. And there is so much of capex done. And you know, you had version 1, 2, 3 coming in Jaguar itself. So you had earlier, you had a China kind of a model for production. Then you did restructuring to improve cost. And now you have shifted your plant out of UK and you are trying to put it up in Slovenia. You have done a new line, you have done everything that is possible and your margins are collapsing. So I do not see any kind of cash flow improvement coming in because you got so much of capex that you have done.
Okay.
So I think it's good money behind bad and it's a top avoid for me.
Okay, Tata Motors, what about you, Samir?
So for me, Indiabulls housing is one of the top avoids. Over there, what is happening, even if you see this time results, the main source of funds is asset sales.
Okay.
The NCDs and CPs, one of the group companies is having a NCD and the response is very low. And if the same requirement comes through Indiabulls housing and the same kind of response comes to that NCD, then they'll face a major squeeze on the source of funds. So, and asset sales is not a continuous thing which you can do to fund your liabilities and grow on that. So I think they'll face a good amount of squeeze in next 6 to 9 months. And this is a good place from my side to get out if you have that. And the future growth is going to be with NBFCs who have long-term funding already in the system, like a LIC housing, Canfin or a HDFC. So I think over there the cost of funds are increasing for others and the availability of funds is almost squeezing out. So I think it becomes very difficult for IBUL to maintain that kind of a growth rate and the source of funds. So for me, it's a top over.
Okay, Tata Motors, Indiabulls Housing Finance. What about you, Umesh?
So I will focus on 2 sectors. So number 1, if a person is fat, he has juice, and a person is skinny, right? So there is nothing more. So all the stocks that are highly valued, right? So FMCG stocks, 60 plus. So if Haldiram is trying to do a deal at 40 times Kellogg's wants to acquire, so if 40 is a benchmark, on a real, businesses are being valued, stock market is valuing at around 60-65 times all those great businesses. So, and we have seen historically that if and when there is a bear market bottom, which we may be into, so the stocks that will fall are the ones who have fat. because that's where money is there, and if people want to raise money, those are the stocks will bear the brunt of the last leg of downfall. So that is the reason we think that it is better to avoid all those
high value FMCG.
Correct, high value quality stocks. Second, debt. All the companies which have debt equity ratio higher than 3 are also very dangerous. And obviously the pledge says, because that it's gone. Globally, we think that debt levels have really increased a lot. So US currently has around $9.5 trillion of household debt, and the GDP of US is around $19 trillion. That's huge. So if that implodes, right? So it's like we know that leverage trading is very dangerous, and they are and that can ruin a trader. Similar is the entire world on in terms of debt. So if that implodes, we have seen Z, we have seen Arcom, and all those stocks. They don't have that capacity to repay. So all those stocks having debt higher than 3 should be avoided.
Okay, that's the view that's coming in on the stocks that need to be avoided. But with that, we're completely timed out on this edition of Hot Money. Many thanks to all of my guests. Vinit, thank you so much for coming in. Samir, Umesh, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.